You've found the FarrCast, your weekly podcast with conversations from across Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. It is the 12th day of December. We're almost halfway through December. We've got a couple of 3 weeks left, and it'll be 2025, folks. Happy New Year. More on that later. And my top 10 list for 2025. 2024 has kind of hung in there, but not been outstanding. Made money, but haven't beaten the index with my 10 stocks this year. I'll have another 10 for next year. I always do. NASDAQ made a new high yesterday. New all-time high. That's big. And stock prices have had a really good year this year. We've been talking about it. They're trading near all-time highs. Yield on the 10-year Treasury after yesterday's CPI number went up. The yield went up, so prices went down. 4.30 this morning, yield on the 10-year Treasury. We get a producer price index today. See what that means. Consumer price index is what the consumers are paying sort of at the store for goods and services and everything else. And they come up with a calculation for that index, and they've got a list of stuff that they price regularly. The producer price index is what the manufacturers, if you can think about it that way, what do the factories have to pay for their raw materials that they go into a pair of shoes? How much is the cost of leather, the thread, the labor, the everything else? Are those prices going up? Because when those prices go up, sooner or later, they push into consumer prices. So we're looking into producer price index today to see if we can expect more pressure on the CPI, on the consumer price index, that'll push that higher. The Fed is moving into their quiet period. It's expected with like a 99% chance of probability. What they're trying to do is take their foot off the brakes slowly and see that they've got rates about where they should be, which is amazing. They ratcheted them up amazingly fast. And okay, they're at a level where inflation's come into an acceptable range and they're in a wait and see mode. Will it keep Trump happy? Who knows? But it looks like Jay Powell keeps his job, according to Basent. That Jay Powell keeps his job through the end of his term. We're watching all of that. Finally, the last couple of weeks, I've been writing about the valuation of markets and the relative price to earnings versus the performance. And this week, and it's coming out today, it's not out yet, I'm going through the earnings growth, and I'm talking about the earnings growth of the Mag 7, how that's driven a lot of the Mag 7 performance. Some of the Mag 7 aren't ridiculously priced at all, Magnificent 7. And then finally, I'm talking about what's going on in earnings growth for the other 493 stocks in the S&P 500. If you want to see a copy, it's free. H. Jennings at farrmiller.com. H. Jennings at farrmiller.com. You'll get my report on S&P 500 returns, a breakdown with the Mag 7 and the contribution of the remaining 493. It's broadening out, and I think that's a very positive sign. Expectations for earnings growth are big for 2025. We'll see, folks. We'll see. If you get a 2.5 to 3.5% GDP growth that the Atlanta Fed says we're going to get, you'll get good earnings growth. You continue to get economic expansion, and that pushes into the rest of the economy. Now, there are always those exogenous events, and we know that President Trump adds to volatility. He doesn't dampen it, right? And that doesn't say that's not a criticism, because a lot of what he does can be very effective, okay? But is it pleasant to go through? No. Take your Dramamine and get ready. What is Kenny Polcari doing? I know that's what you're thinking right now. What's Polcari doing coming into the end of the year? Kenny Polcari, the face and voice of Fox News and the New York Stock Exchange. Watch out, Maria. He's taking your job. He'll be there any minute. He's CEO of Case Capital Advisors. Welcome back.
Thanks, Michael. Welcome back. I'm sitting here actually in a hotel in Boston as I'm getting ready to attend and speak at a Fidelity event. But yes, I hear everything you're saying, and you are 100% right. And I got to tell you, yesterday's CPI report leaves me scratching my head because it, in fact, ticked up, right? And while it was expected to tick up, it did tick up. Now, they're arguing that, well, it didn't tick up more than expected, so that's the positive. And so the market just rallies ahead, and now there's 100% chance of a rate cut next week, which at this point, I'm just scratching my head going, you know what? Jay Powell has backed himself into a corner. He's letting the inmates run the asylum. And he does not want to cause chaos, because I think if he doesn't cut rates next week, then he causes chaos in the last week and a half of the year, which I don't think he really wants to do. So I think he's just going to throw in the towel.
Not over a quarter of a point, Kenny. It's not worth throwing the hand grenade over a quarter of a point. And he's basically doing what he said he was going to do for 3 months, right?
Well, I hear you, but the trader types in the algos, if they don't get a rate cut, they'll just stamp their feet. Now, I don't mean that, the market's going to.
Well, so will Trump. Trump will lose his mind if he doesn't get that.
I understand. But I'm not saying that the market would back off by 10 or 15%. I'm saying they just stamp their feet and create noise over the last week and a half. And I think he's just like, you know what? I'm done with it. And then they'll cut now. But then I think in the first quarter of next year, we won't see any cuts. They're going to wait and see, because there's this new administration coming in. There's lots going on. Plus the data. What's the PPI going to say today? To your point, is the PPI going to, this will be the second month in a row if we see a higher PPI. And to your point, you said it in the opening remarks. That's the price that producers pay. It gets ultimately passed on to who? The C and CPI, which is the consumer. That's you and me, which is what we saw yesterday. It started to tick up because last month's PPI was hotter than expected. And so we saw yesterday's CPI tick up a tiny bit. It did tick up, but not any more than it was expected to tick up, but it did tick up. That's my concern, is that I think, once again, they're going to react too soon. They've already cut rates by 75 basis points. All, they haven't done anything, but I think that they should do nothing. But who am I? I'm a lone voice.
Kenny, let's take 1 minute and just talk about candy bars. Let's talk about candy bars, because candy bars, I believe, sell for about $1 each. Do they not?
No, they used to. You haven't bought a candy bar lately. I had a Snickers bar yesterday. I paid $4.39. I was also at the airport. So, okay, let's price that in too. But a Snickers bar was $4.39.
A Snickers bar? What the hell is a Snickers bar?
A Snickers bar.
Well, you can only get those at Logan
Boston?
Airport.
Are you in Boston?
I bring my Boston out.
Is that in Logan?
No, that was actually in Palm Beach, the Snickers bar.
No way. I wonder if it's a Snickers bar. Snickers bar. I'm going to go to Boston tomorrow and make market in ours. Apparently, they need to buy a few ours in Boston. Okay, look, let's. Kenny, I'm sorry to be so out of. I don't sugar and candy bars and stuff. I don't do, and it wouldn't have gotten my $4.30. I promise. Let's say that they're $2, and that you, as a retailer who sells candy bars, has to pay $1 for each one of those candy bars that you sell for $2, and all of a sudden the price of the candy bars goes up to $1.75. When you go to buy them from the Mars company, you got to pay $1.75. Are you going to sit there now? Everybody, you're selling candy bars with Kenny and me. You really going to sit there and say, okay, I was making 100% profit on these candy bars, and now I'm going to only make a quarter? No, you're not. What are you going to do? You're going to raise the price of your candy bars by at least $1, right?
Bingo.
If it's costing you $1.75, you're going to charge $2.75. And hey, you might charge $3.50 and still make your 100% market. And you're going to pass those costs along. You're not going to suffer as the guy selling candy bars. Kenny, why am I going through this, please?
Because that's exactly what we're going to see today. The producer prices, the guy who produces the candy bar, is going to come out and say whether or not his costs are going up. Because if his costs go up again, then you can expect next month's CPI once again to continue to rise, because he has passed those costs on.
Yes, but what we're also doing is explaining why tariffs are a big deal.
Well, okay, but I don't think, listen, I think he's using tariffs as a leverage. I don't think we're going to get, I don't think we're getting a ton of tariffs.
That's fine. We can use them. And yes, it's very difficult to tell whether President Trump is posturing or whether he's actually talking about policy. Both are very effective, okay? Both are very effective. But the problem is that if he does those tariffs, if he does do it, and all of a sudden somebody has to pay that 25% tariff, guess where it's going? It's coming out of the consumer in the end. If Walmart has the costs of all of its goods and services go up, or even employees has to raise minimum wage, you think Walmart's going to eat it? No.
No, of course they're not going to eat it. But listen, here's the other thing I think, though. I'm really wondering how Americans feel if they impose tariffs and our prices go up, but are you willing to pay those high prices if you know that they're going up because of tariffs versus you're paying higher prices because the Biden administration was just spending like drunken sailors and sending prices higher? We saw prices go up 9.4%, inflation 9.4%, but housing went up 43%, cars went up 20%, apparel went up 20%, food went up 25%. Where would you feel more comfortable? You had to pay that we're actually getting something in return because of the tariffs, or just because we're spitting it away?
You're asking a question that 50% of Americans can't answer. I can't afford to pay any of these prices. And inflation hurts that most vulnerable cohort.
100%.
Spend my money's going to go, for the stuff that I want and need. And I'll grouse about the $2.50 Honeycrisp apple, and I bitch about it, but I can afford it. Right. Other people just don't buy it, and they're not buying fresh vegetables and fruit because the prices are so up. The good news, though, over the past few years is that wages and wage growth have actually outstripped inflation in the past couple of years. That's not bad.
But so here's the next problem. Remember what we went through in 1970, 1980? We had that wage price spiral inflation because wages went up, and in order for a company to pay you more money to work there, guess what? They're going to pass that cost on to me.
Sure.
Right? Because it's the same issue.
So, and that's why, Kenny, we've been talking so much about the unemployment rate, because when we had that JOLTS number and we had twice as many job openings as we had people looking for work, and employers had to find employees, they had to pay more.
Correct.
So that was really inflationary. Now that JOLTS number has come down, now that unemployment has actually gone up to 4 point whatever the percent it is, 3%.
4.2.
That's actually a good thing economically, because it relieves some of the pressure on wage inflation that has been driving a large part of the inflation. So
let's hope it stays
coming back in
that way.
line for Jay Powell, right?
Right. Let's hope it stays that way. I completely agree. I completely agree with you. But let's hope it stays that way.
I'm just quoting numbers. I haven't given you an opinion yet. The opinion is, you're a very handsome, talented guy, Kenny. There's my opinion. Go ahead, argue.
Come on, you're giving away secrets now to all your listeners.
Yeah. Well, that I love Kenny Polcari, everybody knows that. Okay, Polcari. So the economy might be doing just fine. Inflation might be okay. The economic expansion next year, I've got stocks trading at all-time highs. I've got 30 seconds to get out of here. All-time highs. Fred and Ethel want to know what to do coming into the end of the year.
Fred and Ethel, and I've been telling my clients this. Look, relax. You're invested, so you're participating. The new money we're putting to work, we're going to leave in a government money market fund right now, making 4.25%, until we get now through what I think is going to be the new year, because I think they're going to hold it right here until we get into the new year. I think we're going to see a readjustment in January. I wouldn't be surprised if we came down and tested trendline support, which is only about 3% from where we are. 58.80-ish is short-term trendline support. I would love to see us at least pull back and test that. And so that's what I'm kind of waiting for, the weakness that I suspect we're going to get in January, February of 2025.
Here's one other tip, folks. Fred and Ethel, are you worried about your stock portfolio? Have you been worried about it with these prices, with the volatility, with the Middle East, with the Ukraine? And were you worried 6 months ago? Were you worried a year ago? Were you worried 18 months ago? When folks like Kenny and me talk about climbing the wall of worry, that's what we mean. things continue to expand, and you've made a lot of money this year if you've just owned a stock index, right?
Right.
Individual stocks, we'll see. But this is climbing the wall of worry. It's when you get complacent that I get scared. I get worried over complacency. As long as everybody's a little bit worried, things usually end up pretty much okay. Kenny, what are you're talking in Boston today? I got to go. Give me your final word.
Yeah, I'm just talking at a Fidelity conference to a bunch of their national advisors and salespeople about the markets, about exactly what you and I are talking about right now.
Well, you're going to quote me and give me credit by name, right?
100%.
100%. Well, it's about time. Ladies and gentlemen, Kenny Polcari, Chief Market Strategist for Slate Stone Wealth, a Case Capital Advisor, CEO, and my great friend. Kenny, peace, brother. Good luck today. We're going to be back with Mahaffee. Stay with us.
Thanks for being with us this week. Now it's time to go to our political analyst, Dan Mahaffee, and your host, Michael Farr.
Welcome back to the FarrCast. I'm Michael Farr. Thanks so much for being with us this week. It's the 12th day of December. Joining us now, as he does every week now in season 8, the great Dan Mahaffee. His cousins and family members just call him the professor. Sometimes that's with admiration. Sometimes it's with a roll of the eyes going, I wish he'd shut up. I actually have never listened to Dan Mahaffee where I thought, geez, I wish he'd shut up. But then again, I'm not his cousin. A little bit of distance makes the heart grow fonder, as does the appreciation and keeping one's status as an expert. Hey, Mahaffee, welcome back.
Thank you, Michael. Good morning.
Good morning.
Great to be,
Professor.
as always, speaking with you, or hopefully not lecturing, but if we ever hook up my cousin's eyeballs to a turbine, they'd be a great alternative energy source.
Oh, yeah. Well, I've seen them roll their eyes. Hey, Biden's commuting 1,500 sentences, pardoning 39 in the largest grant of clemency ever. We've got Chris Wray resigning. We've got Kash Patel moving into the FBI. We have all sorts of policy, perhaps upset. We've got Canada fighting back. When the hell did you ever think anybody ever say that? Canada's going to fight back. They're going to just stop. They're just going to stop exporting oil and electricity to the mid-northwestern United States. How do you parse through all of these headlines right now? And as I had a listener write in last week, she says, Mr. Farr, would you please remember that Joe Biden is still the president of the United States? I said, don't tell me. I said, don't tell me. I'm reading the headlines just like you. Dan, what should we be thinking?
Yeah. Well, look, I think you see Chris Wray, the Kash Patel story, zoom out. You've got tons of young men and women fawning over Luigi Mangione. I don't think it's a good week for law and order writ large. So I think we can just put a pin in that there and move on. But look, you have this sense of the, are these things a portent of violence, or are political leaders wanting to settle the score? I think just get past the headlines and let's see what's actually said in these hearings. But I know for Director Wray, at least the logic is he doesn't want to turn the Bureau into a lightning rod during the transition, and will bow out to let President Trump make a new pick. But ultimately, let's remember that the FBI director was once supposed to be insulated from this. It's why it's a 10-year position. That was a reform to make it so that the head of the nation's law enforcement wouldn't align necessarily with presidential administrations. But perhaps that, along with the pardoning of Hunter Biden, these other clemencies, which probably in many ways were actually worthy folks who've done their time. I haven't looked in the details. So many of these clemency applications are that, and not the scandalous ones we see mostly in the press. But I think ultimately it does show that a lot of these norms and guardrails that we have institutionally as well as societally are certainly frayed, and something that is generally concerning when you zoom out of the political day to day.
let's just take a look at the case of the FBI. Can you give us an apolitical analysis of the criticism that Chris Wray is with which Chris Wray is being charged by President-elect Trump?
Yeah, largely it's that the FBI participated in what critics call a weaponization of the Justice Department, that the department going back to the Justice Department going back to even the Russia investigation, even though this happened under Trump's own attorney generals, that going back, the FBI has somehow been against Trump and conservatives. It goes on through an arc through the January 6th investigations and the classified document investigations. And on one side, it is simply the FBI doing their job, even if it does involve a former president and his supporters. And to the other side, it's the persecution of the president and his supporter, the president-elect and his supporters, by the so-called deep state or the FBI itself.
So, okay, what I'm trying to sort through is, and listen and read between your lines. Does President Trump have a case for being mistreated here, or does he just not like being held accountable as any other former president or official would have been held accountable? And there's a lot of criticism that Joe Biden had documents at his house and they looked at them and it was okay for Biden, but not for Trump. What am I missing? Because I'm hearing all of it, but I have no way to really say this sounds like materially real and this doesn't. So far, it just sounds like two seventh graders fighting about, your mama wears army boots kind of a thing.
But you've got it just right. And it's, look, there are the events that have taken place. There are the facts at hand. All of this is, again, a political football when we've gone through, as I said, the barriers and guardrails, be it institutionally as well as the media, that were there to insulate law enforcement from these political pressures. So whether someone's being held to account is no longer a matter of justice, but a matter of political opinion.
And so tell me here, is that what we've got? Just political opinion going back and forth? Did Chris Wray cross a line that he shouldn't have crossed as director of the FBI? Or did he basically execute his duty? Did he do the Mike Pence, basically, where he certified the vote, went against Trump, and now he's a no good son of a bitch, according to Trump, because he didn't do what Trump wanted?
Well, yes, in many ways. Was the FBI not going to investigate people storming the Capitol? Was the FBI not going to investigate classified documents held by either Biden or Trump or any other former leader? No, the FBI was going to do their job. But what we now have is no longer whether the FBI is doing its job or not, is whether is the FBI targeting my team or their team. And that's just a dangerous road to be going down with the FBI.
Well, my team versus their team is the theme of the day. We'll see what happens. Give us a quick around the world, Dan, and then we've got to go, brother.
Oh, well, around the world, look, we see, I think in Ukraine, each side is pushing harder and harder to set the lines before there is some kind of negotiation or deal. Honestly, on the China front, I'm going to give kudos to Trump with his invitation to Xi to the inauguration. Frankly, it is a smart move, I would say, if done right. One, because you make Xi come to you. It sort of changes and inverts their sense that all powers need to come to Beijing to pay homage to them, and also makes Xi look like a bit of a shying away from the global stage if he doesn't attend. So I think that was an interesting move there. But China continues its military exercises around Taiwan, which folks are watching. And then beyond that, you have the general sense of where is U.S. policy going? The Nippon Steel deal being seen in Japan as a very questionable move that both Biden and Trump would be opposed to a close partner joining in and investing in our economy. That, again, sends a strange message at a time when the U.S. wants friends and partners. What are we doing to our friends? And then I think that brings us finally close to home.
Steel thing.
Go ahead,
I might be missing the steel thing. I get the TikTok thing. Okay, I get why we don't want apps on the phones that have location as a part of them, so that you can tell where everybody with Tic Tac is at every moment, where they can see how many phones have just stopped in the Pentagon parking lot, and can tell almost who's there. Yeah. And can tell how many people are on Capitol Hill and in the Senate building and in the
propaganda
House
to our children on a regular basis. Yeah.
This is I get this.
That's
I
TikTok.
get okay. But steel, I mean, steel's a commodity. I suppose you could degrade it or somehow sabotage it.
Michael, there's no business or security sense behind this. It has to do with the Electoral College and 20,000, 30,000 votes in Pennsylvania.
Well, what will President Trump do? Will he be less sensitive, do you think, to the Electoral College, sort of a standard in that he can't run again?
No, I don't think that will matter. But separate from that, on the politics of this, it will be with Trump that his concept of anti-globalization will prevail over any kind of deal there.
Okay, and I wonder if President Trump will see J.D. Vance as a legacy, getting him a third term, as happens to many two-term presidents. We'll watch that too. Give me a Middle East, Bibi Netanyahu. What's going on there? And we got to go.
Yeah, look, with the fall of the Assad regime, questions about the future of Syria. But look, you see the Israelis doing what they think is necessary for their security. They've pushed into more of the Golan Heights. Bibi will stay, though, because, again, his security message is one that prevails with the Israeli electorate, even if by a knife's edge.
By a knife's edge. Dan Mahaffee, his vice chairman of the Dr. Scholl Foundation, scholar for the Senate of the Presidency, studied the presidency in Congress, our great friend and senior analyst here on the FarrCast Season 8. Can't believe it. Dan, we'll be back again next week. We'll do it all again. And I can't imagine what we're going to talk about, but there will be more and more headlines. We never get bored with politics. Thank you, Dan.
You're welcome. Take care, Michael.
Coming up, segment 3, Shelby McFaddin from the Motley Fool. She's a senior investment analyst, covers stocks, comes up with new ideas. We're going to find out what's going on from the Motley Fool and Shelby in segment 3. Please stay with us.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. We appreciate you listening into the FarrCast this week. And now to introduce this week's special guest, here's your host, Michael Farr.
Welcome back to the FarrCast. Good FarrCast this morning, talking to Kenny Polcari. And when we go, he's up in Boston, telling us about candy bars, of course. Mahaffee, terrific once again, trying to explain how the politics are getting in the way of governing. Interesting, I think. But I don't think that's going to change anytime, folks, and it's going to continue to add volatility. President-elect Trump historically adds to volatility. This is not a political comment, ladies and gentlemen. He adds to volatility, and he likes it. And he likes adding to volatility, and sometimes it's very effective. But don't expect a calmer, gentler Trump. I don't think calmer, gentler actually has ever been used in a sentence up until right now with Donald Trump. So a little more volatility going into 2025. And then we have to look at valuations. You know, the line in the fish market is ignore the screaming and the yelling and pay attention to the price of fish. And when we want to pay attention to the price of fish, we look for experts like Shelby McFaddin, who is a senior investment analyst at Motley Fool Asset Management. And she's a pro's pro. She's been in the business for a while. She was at Strategic Investment Group. That's a really big deal. Strategic Investment Group, they're an OCIO, but they create their own indexes. They do some really brilliant work over there. She was there, George Washington University, graduate degrees in economics and international affairs. You want to talk to somebody who's smart, who gets it? Shelby McFaddin. Pay attention when you see her on TV. Shelby, welcome to the FarrCast.
Thank you, Michael. It's great to be here.
We're glad you're here. Shelby, okay, Shelby, here's my deal. If GDP grows next year at 3%, even though stocks are at 22 times or a little slightly higher earnings, we can still see a positive year returning from stocks based on that earnings growth. We should see pretty good, reasonable earnings growth. Is it 10%? Is it 15%? I don't know, but it could be good earnings growth if we get 3% GDP growth. And then what do you think about markets? Do you agree with me? And what do you think about a market that's been driven by this magnificent 7 stocks that are have had these fabulous earnings growth, great performance, and then there's the other 493? What do we do if we're Fred and Ethel trying to figure out, I've still got to manage my 401k, Mr. Farr?
Of course, yeah. At Motley Fool Asset Management, the way we've been kind of looking at it is this. Realizing that some of that expansion, that multiple expansion, and some of that earnings growth is going to temper a bit. Should still be positive for many years to come, but going to be a little bit more depressed. And when we're looking out, we're also realizing that some of that may not be real earnings growth, realizing that it's going to be a little bit more inflationary. As a team, we have discussed the concept that the sort of new threshold is going to be a bit higher. We have discussed the idea that a return to 3% rates, that may not be something we see in 5 years if there's no politics involved. If we're purely looking at the monetary policy of it all and the levers that the central bank would normally pull, it could be that the new normal for us as a country could be something that settles around 4s, mid 4s. And if that's the case, then earnings is driven a bit less by real productivity and more of a little bit by inflation. So seeing that increase in the base rate, sort of increase in the standard yield that we'd be seeing across the market, and that being what's driving the increase in earnings. Then when we look at what should Fred and Ethel do.
Hang on. I want to stop you because there's a lot to unpack in what you just said. And there were more than a couple of very important points there. But I can hear listeners who are on the treadmill right now and with their AirPods on going, boy, she sounds smart. I'm not sure what all of that means. So here are the two things I want to pull out of that. One, you talked about earnings going up, but earnings go up a little bit more because of inflation. Give me a quick explanation of that. Would you? What do you mean by that? That's something you're looking at Motley Fool.
Absolutely. So when we think about the sort of income statement, if we will, we start at the top line. Most companies are charging more for their goods and their services. So this is sort of economy-wide, not just what eggs and peanuts cost at Costco, but what any of the sort of enterprise software companies are charging. Everyone's charging a bit more. Now, companies, depending on their scale and where they are in their life cycle, are able to expand their profits a bit more depending on how much they increase that ticket price. And then also simultaneously, how much they're able to save on labor and other cost of products sold or services sold while they're increasing that ticket price. And so if inflation, because they face their own sort of cost inflation, is a method for them to simultaneously shrink some expenses because they have to get more creative, while also expanding that sort of top line, then you have a new method to increase earnings that is beyond the sort of operational leverage that we've normally seen, which might be just decreasing labor, offshoring labor. Then when you actually throw in the other component of increased productivity from AI. Now, here's the asterisk. When I say that, I mean the most practical uses. So think about when you've gone to the grocery store. We've seen a lot of complaints that people just want to be checked out by a cashier and they're not there. Well, that's a savings from AI that's as old as time, right? Maybe not as old as time, maybe the early 2000s, but self-checkout used to be a delicacy. Now it's a standard. That's a huge labor savings because even if you're only paying the state minimum wage, you multiply that by several shifts, you've made a big difference. So when we take what companies have done to counteract the inflation that they face, it's an opportunity for some of them to increase earnings just by the sheer fact that they've gotten more creative with operational leverage and they've expanded the top line to make sure that they're preserving some profit. So we're not talking about multiple percentage points, but there's a little bit there. For some of the most advanced companies, you could maybe get an extra 100 basis points or so just from the extra pricing that you're putting through.
In the late 90s, one of the top gurus that I used to follow, and I continue to follow, I think she's brilliant, Abby Joseph Cohen from Goldman Sachs, was the voice of the dot-com rally and reason and what was going on with this new internet thing and all of these dot-com things that were all brand new. Abby Joseph Cohen continued to look down and from a macro point of view, and she made a couple of points, awesome points. One of them was that when inflation is around that 2% level, you get a higher multiple. You can have a higher multiple because you're looking through at clean earnings, what she called clean earnings. And think about it this way, folks, because it's what Shelby is actually talking about here. During inflationary periods, if you're manufacturing stainless steel pipe and you have a warehouse full of flat rolled stainless steel getting ready to turn it into tube and pipe, and the price of the stainless goes up because it's of inflation, right? And all of a sudden the stuff that you bought and inventoried is now you can sell it for more. You haven't added value to your stainless steel pipe or your management decisions or your operations. You just got lucky that you had a bunch of this stuff sitting around when the price of it went up, and all of a sudden you're showing profit growth. And it's not because you're brilliant, and it's not because you can, and it's not going to be something likely you're going to be able to repeat on and on and on. Okay, because your next load of stainless steel you're going to pay more for, and you're not going to have those same high margins. So she says when those periods of high inflation are coming, price to earnings multiples drop. Well, price to earnings multiples are moving back up, maybe in anticipation of low inflation, but that idea of clean earnings is what Shelby's talking about. I think it's very, very important as you look for stock prices. So, Shelby, with all of this, and I'm thinking about our time here, and I know I don't have you for too long, but give us some ideas about how we invest, where you find opportunity in a market that's trading at all-time highs.
Yeah, I think right now this is one of the best times to be active investors. So at Motley Fool Asset
What do you mean by an active investor?
So trying to, in the simplest way to put it, trying to beat the broad market. So looking for those opportunities.
I don't want to just own an S&P 500 index fund.
No, that's going to keep you purely passive. And let's be honest, that's done a lot this year, right? It's not to say that
I've got 28% or something.
It's not to say that that the market itself is not moving and not doing great things for investors. I'm sure in my retirement fund, we've got some amount allocated to just pure play broad market. But getting active, especially on different levels like market cap and things like that, trying to beat the index can give you an improved sort of downside capture, where when things are difficult, you're able to sort of perform better than the market when the market is not performing very well. And then the sort of cherry on top would be getting a better upside capture, which is sort of beating the market even when the market is doing great. So going into this sort of new administration, going into the remainder of this part of the interest rate tuning cycle that the Fed is in, we find being active to be very advantageous because the market sometimes paints a broad brush on one particular sector or one particular capitalization. And it gives us an opportunity to sort of buy when things are being unfairly punished and not have to time the market when things come back into favor. So when we think about small caps, everyone knows the Russell 2 has just been beaten up for the past couple of years.
Yes.
But when you stay disciplined and you keep finding those companies that they're doing well, they are progressing on their objectives, their customers are still being loyal, their retention is nice and sticky, and you realize that their stock price is just getting punished, you stay invested and you stay active in those positions because chances are when rates start to come down, suddenly the Russell 2 looks a lot more exciting and you no longer have to time the market. So that's a great example of active management and staying invested. And that's what I would tell Fred and Ethel is, yes, they might have to change that sort of overall allocation to fixed income and equity, but having some equity right now, although it might seem volatile, it might seem a little bit scary, there are ways to still manage your portfolio and your overall allocation to enjoy the sort of spoils of this equity market that we're in.
You know, Shelby has said so much that's really important today to listen to, some really, really good advice. But what she just said there was it's great to look at stocks when everybody else hates them, when everybody else doesn't like them. So that's what Warren Buffett does, by the way, ladies and gentlemen. Warren Buffett loves it when everybody else doesn't like it. And then, but the second part, which is probably the most important, in my opinion, and I would say also in Warren Buffett's opinion, would be you look at the fundamentals. You look at what's going on. You see what's creating value, what's going to drive value. Is it sustainable? Do they have good management? And do they have good intrinsic value is what Buffett would say. We look at it in a different way. But in short, there has to be some there that drives value. And if you can determine that you're not paying too much for it, or that there are prices that have been driven down just based on emotion, great, I'll buy it all day long. And so when I look, there's a software company, I'm not going to mention its name, but software company today reported earnings after the close last night, stocks down 11 or 12% pre-market. I'm going to look at that one very closely today based on those fundamentals, because I did listen to the CEO last night. He painted a very positive picture of what they're doing, how they're expanding, increase subscriptions, increase users, increase this, increase that, and they had a problem from FX. Now, there might be more problems, which is why I've got to look at it more closely. But FX is foreign currency, and it's when you are a U.S. company and the dollar goes against you, all of a sudden you have to lower the translation, even though you're earning money in those other currencies, you sort of lose money as you translate it back in the dollar. And we've had a very strong dollar, and that's what's happening. So is it just a currency problem? Because that's not something the fundamentals of a company can really control. And please don't start with me about hedging, ladies and gentlemen, and how I'm going to hedge the currency. You can't hedge currency. I don't care. All the people want to tell me we're going to hedge currency. You can't hedge currency. You can't. Sorry. It's just, no. You can trade currency. You can speculate with currency, but you're not going to hedge it. More for another FarrCast that will bore the hell out of you. Okay. So anyway, I love that idea. Shelby, I can't mention individual stock names right now. Is there somewhere we can follow you and get some of your ideas and follow you over at Motley Fool?
Yeah, so I have my Twitter account. So you can find me there, a little bit on LinkedIn as well. Because we are a regulated business, I am a little bit limited on certain things, but you can always find some of my opinions and opinions of the team in any sort of Google search from different outlets that we've participated with. And yeah, that's mainly where we are. We are a little bit tight because we have to make sure that the lawyers are happy. But yeah, LinkedIn and Twitter, I'm around.
Shelby McFaddin is Senior Investment Analyst at Motley Fool Asset Management. And you've heard it, folks, one of the smartest people we get to talk to here on the FarrCast. I hope you'll come back, Shelby.
Absolutely.
Ladies and gentlemen, that's it for another FarrCast as we cover Wall Street, Washington, and the world. 12th day of December. My niece, Amelie Colwell Ward's birthday today. Happy birthday, sweetheart, from Uncle Michael. We'll be back next week. We'll do it all again. On behalf of my producer, Harry Jennings, everybody at Hightower Advisors and Farr Miller in Washington, we thank you for listening. Please share us on social media. I'm Michael Farr. See you next week.
Thanks for joining us this week on the FarrCast, and thanks to our guests, Kenny Polcari, Dan Mahaffee, and special guests from the Motley Fool, Shelby McFaddin. We'll be back with you next week with scheduled special guest Joshua Huminski with a deep dive into the geopolitical flashpoints he's watching as we end the year. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And if we can be of assistance, please reach out to me at hjennings@farrmiller.com. And I'll be happy to put you in touch with one of our investment professionals to help you navigate your financial course. We are grateful for all of your notes and comments, and we try to respond to as many as we can. Please Please keep the emails and messages coming. Take care, stay safe, stay healthy. We'll be back with you next week on the FarrCast. Wall Street, Washington, and the world. Farr, Miller & Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr, Miller & Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr, Miller & Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.